Welcome to the Explainer. All right, let's just dive right into this intense, high-stakes debate surrounding a company you definitely know, but probably not like this. We're talking about Nokia. Now, right now, Wall Street is whispering the absolute magic word when it comes to this stock, and that word is AI. I mean, they've got a massive $1 billion check from NVIDIA, an absolute treasure trove of 5G patents, and they've been trading at a triple-digit peak PE ratio. The mainstream media is out there painting this fairy tale of AI disruption, but today, we're going to look right past that hype and dig straight into the harsh financial reality. Because here's the reality check, and it starts with a pretty staggering number. 44%. The stock has completely crashed from its highs, falling from $17.45 down to just $9.73. Now, a massive drop like that, especially in a tech stock backed by all this AI buzz, well, it immediately begs a massive question. Is this drop a generational buying opportunity? Like, are we looking at a deeply discounted tech disruptor here? Or is this a value trap perfectly disguised by that shiny magic word, AI? That is the central investigation of our explainer today. We really need to figure out what's going on beneath the surface.
So, Section 1, the ugly truth, 4 red flags. Let's just rip the Band-Aid off. We are going to look at the bombshell red flags that the press releases and the mainstream hype simply will not touch. There are 4 major ones you absolutely need to understand.
Red flag number 1, we're calling it the cash mirage. If you glance at Nokia's Q2 2026 earnings, you are going to see a very respectable 18% rise in operating profit. Sounds fantastic, right? But beneath the surface, free cash flow actually plunged to a staggering negative 700 million euros. At the exact same time, their net profits are actually down 95%. So what does this actually mean? It means those exciting AI contracts might look great on an income statement, but they are just paper profits. The net liquidity is evaporating, and the tangible, actual cash is simply not hitting the bank account. Moving on to red flag number 2, and this is a classic accounting gimmick. Recently, Nokia made headlines by raising its full-year guidance. Normally, that's a massive green light for investors. But how did they actually achieve it? They didn't miraculously fix their underlying business. Instead, they took 2 heavily struggling business units and just reclassified them as discontinued operations. They essentially took the worst parts of their business and hid them off the main income sheet. It's pure financial sleight of hand to make the remaining numbers look prettier. Which brings us to red flag number 3, the 100x PE trap. At its peak, Nokia was trading at a trailing price-to-earnings ratio of over 100, and today it sits at a forward PE of around 36. Now, you only pay those kinds of premiums for hyper-growth tech companies. But check out this breakdown. The high-growth AI and cloud segment, the entire reason people are paying this valuation, makes up just 8% of their total revenue. 8! The other massive 92% of their business is low-growth, highly commoditized legacy telecom. You're basically paying a Ferrari price for a business that is 92% minivan. And finally, red flag number 4, supply chain darkness. Nokia's CEO has explicitly warned the market that DRAM memory shortages could severely impact them all the way until 2027. And this isn't just some hypothetical risk. Their competitor, Ericsson, just saw its stock tank 12% on this exact same issue. Consequently, Nokia's stock has completely broken below its critical technical support levels. And as any seasoned investor knows, when a hype-driven stock breaks its technical backbone, the selling pressure only tends to accelerate. All right, Section 2, the defense, a triple-layered moat. Look, to be completely objective here, we cannot call this a total disaster without acknowledging Nokia's very real competitive advantages. They are not a flash in the pan. They have some serious underlying strengths. Nokia isn't just surviving. They have built a triple-layered intellectual property moat. First off, they are absolute wizards in optical technology, recently showing off cutting-edge 1.6 terabit pluggable modules. Second, and honestly, this is massive for geopolitical and supply chain security, they control their own indium phosphide wafer fabs. That means for their critical optical chips, they don't have to rely on third-party giants like TSMC or Intel. Third, they are successfully breaking into the highly lucrative data center switch market, already securing Microsoft and potentially Google as clients. Add in their top-tier 5G patents, and frankly, Nokia has the bones of an absolute champion. But yeah, there's a big but here. There is a colossal hole in that very moat. Competitor Ericsson is already shipping AI-native wireless networks right now, today. Nokia's equivalent, AI RAN, will not be ready until 2027. In the rapidly evolving tech landscape, a 2-year lead for a direct competitor isn't just a gap, it's an absolute eternity.
Okay, Section 3, the ultimate valuation gauntlet. So we've got severe red flags battling against top-tier intellectual property. How do we actually resolve this? Well, we put Nokia through the ultimate valuation gauntlet. We are going to stress test these numbers against the cold, hard frameworks of three of the most legendary investors in history.
Let's start with the Benjamin Graham test. Known as the father of value investing, Graham used a very specific, ruthless formula relying on earnings per share and tangible book value to strip away the hype and find a stock's true intrinsic value.
Let's look at how Nokia fares here. Taking Nokia's tangible book value of $2.84 and an EPS of 33 cents, Graham's formula calculates Nokia's intrinsic value at exactly $4.57 a share. Now remember, it's currently trading at $9.73. That means investors today are paying a staggering 113% premium over what the ultimate value investor would deem fair. Graham wouldn't just decline this, he would literally walk away immediately.
Our second stress test comes from growth investor Peter Lynch. Lynch's golden rule is the PEG ratio, which basically dictates that a company's growth rate must essentially match its PE ratio to be fairly valued. So if your PE is 10, your growth should be 10%. But when we look at Nokia, their 5-year EBITDA growth rate is currently trending towards 0%. Because the growth is essentially non-existent right now, Nokia doesn't even qualify to be run through Lynch's formula. A pure growth investor simply wouldn't touch this because it isn't growing fast enough to justify its trading multiple. And finally, we put it through the Warren Buffett test. The Oracle of Omaha looks for absolute quality, requiring a high predictability rank and 4 very strict criteria before he even considers writing a check. When we run Nokia through Buffett's ruthless checklist, the cracks really start to show. Let's just run down the list. Do they have a simple business? Fail. They're in the middle of an incredibly messy transition from legacy telecom to AI. Do they have predictable earnings? Fail. As we just saw, net income crashed 95% year over year. Do they have a moat? Pass. Their optical tech and patents are incredibly strong. Do they offer a reasonable price? Fail. They are trading at a massive premium. Failing 3 out of 4 tests means Nokia lacks the predictability and the safety that a true quality investor demands. Which brings us to Section 4, the final verdict: bones of a champion, price of a superstar. When you strip away the flashy headlines and all those AI buzzwords, you're left with a fascinating yet frustrating contradiction. Nokia has the bones of a champion, for sure, but it is currently demanding the price tag of a superstar. It's forcing investors to pay a massive premium today for an AI future that is still literally 2 to 3 years away. Let's just summarize the reality of the balance sheet. The optical tech is cutting edge, and that NVIDIA backing is a massive, real vote of confidence. If Nokia can successfully pivot fully into data centers and fix those DRAM memory supply issues, it's entirely possible that today's price of under $10 could look incredibly cheap in 5 years. But we have to live in the present. Right now, cash flow is negative. That massive legacy telecom business is acting like an anchor on the rest of the operation. And fundamentally, it fails the stress tests of Graham, Lynch, and Buffett. The media is loudly selling an AI dream, but the actual balance sheet is quietly telling a much slower, considerably riskier story. So I'm going to leave you with this final thought to consider based on everything we've unpacked in this explainer today. Are you looking at a deeply misunderstood value play that is just waiting for its turnaround moment? Or has all the future AI hype already been dangerously priced in today? Weigh the facts, look at the balance sheet, and decide for yourself. Keep learning, stay focused, and I'll catch you in the next explainer.